Welcome back to Wall Street Podcast. Today is Thursday, July 3rd, 2025. We're diving deep into today's Wall Street Journal, pulling out the key insights impacting markets, business, and the economy. Our goal, to get you informed quickly without the noise. Let's get into it. Okay, so markets yesterday saw some interesting moves. What stood out?
Well, gains in big tech definitely pushed the S&P 500 and NASDAQ higher, new records actually, up about 0.5% and 0.9%.
Right.
But the Dow slipped just a tiny bit, less than 0.1%. And what's really interesting is the story behind some of those tech names. It's not all smooth sailing.
Exactly. That underlying story is key. Let's talk Tesla first. Headlines haven't been great on the sales front, have they?
No, they really haven't. Tesla's facing one of his tougher sales streaks.
Yeah.
Global vehicle sales fell, 13.5% in Q2 compared to last year.
Wow.
Yeah, and deliveries were down similarly. And that follows a 13% drop in Q1 deliveries too, so it's a pattern.
Okay, so sales are down, but Elon Musk is talking up autonomous vehicles, humanoid robots, calling it the bright shining citadel on the hill. How does that square?
That's the million-dollar question, isn't it? He's definitely painting a future vision. But you've got, 3/4 of their 2024 revenue still coming from selling cars.
Right. And competitors aren't standing still.
Not at all. GM, BYD, they're pushing out high-tech EVs, gaining share. Plus, we're seeing some consumers actually shift back to traditional cars. U.S. EV sales dipped about 7% in Q2.
So a potential disconnect there between the long-term vision and the current market.
Precisely. It's a fascinating tension.
And this ties into that contrast you mentioned, some tech soaring, others restructuring, like Microsoft.
Exactly. Microsoft plans to cut another 9,000 workers. That's after earlier cuts, so it brings the total reductions to about 15,000 in just the last 2 months.
15,000, that's substantial.
It is. And it's not just Microsoft. We're seeing this across different sectors. Companies looking to get leaner, boost productivity, often relying more on tech, like AI, to do tasks previously done by people.
A clear trend towards efficiency, maybe efficiency driven by technology.
Yeah, I think that's a fair way to put it. Significant shifts in how businesses are thinking about staffing.
Okay, let's zoom out from specific companies to the broader economy. The U.S. job market, always a big focus. Headline numbers look one way, but the details.
The details often tell a different story. So economists expect today's Labor Department report to show maybe 110,000 jobs added in June.
Okay.
But there's quite a bit of evidence suggesting those headline numbers might be, well, a bit inflated initially.
How so? Those are revisions we always hear about.
Exactly. From January through April, for instance, the monthly job gains were revised down by an average of 55,000 jobs each month.
55,000 average downward revision.
Yeah. Think about March. The first number was 228,000 jobs added. Then it got revised way down to 120,000.
That's a huge revision. Why does that happen?
Well, part of it is how the data is collected. The initial survey might capture larger, more stable companies quicker. Smaller companies, maybe struggling more, or newer companies, might only get fully counted in later revisions. It suggests the initial picture might be rosier than reality.
So if the revisions keep pointing downwards, what does it actually mean for the labor market? Is it strong or?
It suggests things might be more stagnant than the headlines imply, like people who have jobs are generally keeping them. But for people looking for new work, think recent grads, people try to switch jobs, it seems tougher to find openings. And there are other indicators. The household survey, which is different from the main business survey, shows a smaller gain over the past year, about 1 million jobs, versus the 1.7 million in the establishment survey.
Interesting divergence.
And ADP data, focusing on the private sector, also points to a slowdown, especially hitting smaller companies harder.
So a more complex picture than just that one big number each month.
Definitely need to look under the hood.
Okay, let's shift gears globally now. Over in the UK, some turbulence in their bond market.
Yes, quite a bit. Investors sold off British government bonds and the pound dropped sharply.
What triggered that?
It came after the new Labour government backed away from plans to cut welfare spending, which is ballooning. And this really points to a broader issue for many Western European governments, actually.
Which is?
Weak economic growth. It makes it incredibly hard to generate enough tax revenue to cover rising costs, especially with aging populations.
Right, the demographic pressure.
Exactly. The UK already has its highest tax burden since World War II, and growth forecasts are, well, pretty meager. Around 1% for 2025 is the current outlook. It's a really tricky balancing act.
A fiscal tightrope, indeed. And unemployment ticking up slightly in the Eurozone, too?
Just slightly, yeah. Up to 6.3% in May, from 6.2% in April. Not a huge jump, but it signals some nervousness among European businesses.
What's driving that uncertainty?
Things like potential trade issues, maybe related to the Trump administration's stance, rising oil prices, it creates jitters. We've seen big names like Audi and Siemens also talking about workforce reductions as they adjust.
And speaking of policy differences, the EU is setting some very ambitious climate goals.
They are. They're aiming for a 90% cut in greenhouse gas emissions by 2040 compared to 1990 levels.
90%. That's huge. How does that compare to the U.S.?
It's a stark contrast, particularly with the Trump administration's approach, which is much more focused on fossil fuels and looking to cut support for clean tech like wind and solar.
So a real divergence there. Could that cause friction?
Absolutely. You can see tariffs on clean technology, for example. That might actually slow down Europe's green transition if components become more expensive. Adds another layer of complexity to global trade, definitely.
Okay, fascinating macro view. Let's move into the investment world and some key business headlines. One big shift seems to be private markets becoming more accessible.
Yes, this is a really interesting trend. Even Vanguard, the king of low-cost index funds, is teaming up with Blackstone and Wellington Management. Vanguard and Blackstone. That's an unusual pairing. It is. They're creating a new fund mixing public and private assets aimed at regular retail investors.
Hmm.
And they're not alone. State Street, BlackRock, others are doing similar things.
What's the pitch? Democratizing investing.
That's the narrative, yes. Giving everyday investors access to things like private equity or private credit that were previously only for big institutions. But let's be honest, it's also a way for these asset managers to charge higher fees.
Ah, okay. Because fees on traditional funds are so low now.
Exactly. They're approaching zero in many cases. Private assets allow for much higher management fees, which is obviously good for their bottom line.
But what about the risks for the average person putting money into these?
Oh, the risks are significant. First off, fees are higher, as we said. Second, liquidity is a huge issue.
Meaning it's hard to get your money out.
Very hard. Your savings could be locked up for maybe 5, 7, even 10 years. Not suitable if you might need the cash unexpectedly.
And valuations. How do you know what these private assets are really worth?
That's another challenge. They're illiquid. So valuations often rely on the fund manager's own estimates, which might not reflect current market conditions or could lag public markets significantly.
And the government might even encourage more of this.
Well, the Trump administration is reportedly drafting an executive order to make it easier to include private investments in 401k plans. That would really open the floodgates if it happens.
Definitely something for investors to watch closely. Okay, another area seeing change crypto. Ripple is going for a national banking license.
Yes, that's a potentially huge development. Ripple manages cross-border payments, and they have a dollar-backed stablecoin, RLUSD. They've applied to the OCC, the Office of the Controller of the Currency.
What would getting that license mean?
It would bring their stablecoin under federal oversight. That sets a much higher bar for transparency and regulation in the stablecoin world. Potentially, they could even hold their reserves directly with the Fed. It's a major step towards integrating crypto into mainstream finance, making it seem more legitimate, perhaps more stable.
Interesting. And back in the traditional corporate world, activists are still shaking things up, like at TripAdvisor.
They are indeed. Starboard, a well-known activist investor, has built up a stake of over 9% in TripAdvisor.
And TripAdvisor had turned down takeover offers before, right?
Correct. The company's main brand, the review site, has been struggling a bit. Revenue fell 8% last year. But its other businesses, Viator and The Fork, those are actually growing.
So Starboard probably sees value there, wants them to focus on the growth parts.
That's the likely play. Pushing for strategic changes to unlock the value in those growing segments, perhaps even separating them. Activists look for spots where they think management isn't maximizing potential.
Makes sense. And finally, a bit of a warning from the solar sector, Sunnova's bankruptcy.
Yeah, that's a tough situation. Sunnova Energy filed for Chapter 11. The big impact is on its dealers. About 175 of them are collectively owed something like $347 million.
Ouch. How did that happen?
Well, apparently, months before the bankruptcy, Sunnova asked its dealers to change payment terms. They'd pay less upfront when the solar system was installed, and more later once it was operational.
Trying to conserve cash, presumably?
Exactly. But the dealers felt trapped because their contracts apparently stopped them from finding other financing for these projects once they were installed, even if Sunnova wasn't paying them.
So they were stuck. A real cautionary tale about supply chain risks and contract terms.
Absolutely. Highlights the vulnerability of smaller players depending on a larger partner.
Okay, let's try and connect some of these dots now with questions that might be on people's minds. First up, tech. We see record highs for some, but massive layoffs at places like Microsoft, and executives like Ford's CEO Jim Farley talking about AI replacing potentially half of white-collar jobs. How should investors, or even just employees, read these mixed signals about AI's long-term impact?
That is the question right now, isn't it? What's shifted is how openly executives are talking about potential job displacement from AI. Before it was more hedging.
Right, more cautious language.
Now you have Farley's prediction, JP Morgan Chase expecting headcount cuts of 10% or more, Amazon's CEO anticipating a smaller corporate workforce, even Shopify pausing hires unless AI can't do the job.
So is it net job loss or just reshuffling?
It points towards a significant restructuring and reshuffling. Maybe not fewer jobs overall necessarily, but different kinds of jobs.
Yeah.
The skills needed are changing rapidly. It's less about just what you know and more about how effectively can you use AI to amplify what you know. Understanding AI isn't just for tech people anymore. It's becoming a core competency.
So, a fundamental shift in required skills across the board. Okay, next question. We talked about the confusing U.S. job data with those big revisions and the volatility overseas, like in the UK bond market. Beyond just the headline numbers, what are the key indicators you should really watch to gauge the true health of the global economy?
Great question. First, on job numbers, always watch the revisions. They often paint a much more accurate, usually slower, picture than the initial release.
Look past the first splashy number.
Exactly. Also, track the difference between the establishment survey and the household survey. That divergence can tell you something. For bond markets, yes, watch daily moves. But more importantly, look at the long-term yield trends. And pay attention to why investors react. Like the UK situation, the sell-off wasn't random. It was a direct response to a policy decision about fiscal sustainability.
So, it reflects underlying concerns about debt and revenue.
Precisely. The real signal often comes from tracking capital flows. Is money going into productive investment? Or is uncertainty causing companies and investors to hold back? And are governments on a credible fiscal path? Those underlying trends in capital allocation and fiscal health are often more telling than any single monthly data point.
Follow the money, not just the headlines. Got it. Final question. We're seeing these big pushes into new territory asset managers bringing private markets to 401k, crypto firms, like Ripple seeking banking licenses. For individual investors, what are the real opportunities and, maybe more importantly, the biggest risks in these previously off-limits or unregulated areas?
The opportunity is clear. Access. Access to things like private equity or private credit that historically you needed millions to get into. Potentially, that offers diversification and maybe higher returns that aren't perfectly correlated with the stock market.
And for crypto?
For crypto, getting things like a national banking license, like Ripple is trying for, signals a move towards regulation and oversight. That could attract more serious institutional money and maybe lead to a bit more stability. That's the bull case.
Okay, sounds good. But the risks?
The risks are substantial. For private markets, remember, high fees and very low liquidity.
Yeah.
Your money is locked up, potentially for a decade. That's a huge commitment.
Not for your emergency fund.
Definitely not. And valuations, as we discussed, can be opaque and lag reality. You might not know the true value of your holding for a while.
And crypto risks remain.
Absolutely. Even with more regulation, volatility is still the name of the game in crypto. So the bottom line, for individual investors venturing into these spaces, you need to do way more homework. Understand the fees, understand the lockup periods, understand the underlying assets, and be brutally honest about your own risk tolerance and time horizon.
So, higher potential rewards maybe, but definitely higher complexity and risk.
That's the trade-off.
So, wrapping this up, what does it all mean for you, the listener? Clearly, the financial landscape is shifting fast. Old giants, new players, everyone's adapting.
Yeah, it really underscores the need to stay vigilant, to think critically. You have to look beyond the easy headlines, whether it's jobs, company strategies, or these new investment options. Understanding the nuance is key.
We've covered a lot: tech's mixed signals, the global economy's currents, the changing face of investing itself. So as you think about all these shifts, here's something to consider. In this environment where traditional investing and these newer alternative frontiers are starting to merge, how will you rethink your own portfolio strategy to navigate what's complex, maybe risky, but also potentially rewarding? Something to mull over until our next deep dive.